In today's episode, we're opening up the listener mailbag. We have questions in regards to whether or not you should pay off your home mortgage, how or can you potentially convince your spouse to retire, and then a question from a listener who's looking to leave an inheritance to their children, but they don't want Uncle Sam to become the biggest beneficiary. So stick around, as you might be finding yourself asking the same questions or being able to utilize some of the strategies that we talk about today in your overall financial picture.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Retirement Show, all about your life, your money, and today is about your questions. That's right, we've got a mailbag episode today. Questions in regards to should you or should you not pay off your mortgage if you've got the money in the bank to be able to pay it off. How could you convince your spouse to retire? And the last question is taxes on inheritance. We have a couple with money that they feel like will go unutilized by them. They look to leave it to their children, and they want to do it in the most tax-efficient way. I'm Scott Searins. I'm your host. My goal is to help you thrive in life, wealth, and retirement. And before we get into today's questions, I would say if you haven't yet, really suggest you go check out our YouTube channel. If you're enjoying the content here on the podcast, check out our YouTube channel, subscribe to our YouTube channel. You can find it, it's Searins Financial Group. That's Sierens, Searins Financial Group. You start typing that in, it'll find it for you. Click on it, take a look at our page, subscribe. You're going to find some of our latest videos on there, like the 10-point checklist to understanding if you're ready to retire, 3 mistakes to avoid planning for retirement as a couple, and then 3 factors to consider before you file for Social Security. Couldn't get that one out today, huh? 3 factors to consider before you file for Social Security. So check it out. Lots of good videos there. We're continuing to come out with new videos on the YouTube channel, again, to help you minimize your overall tax situation, help you retire with confidence, and help you in regards to building wealth and things like we're going to talk about today. What should you do with your mortgage? What should you do in regards to retirement? And I love to talk about taxes. And our last question today, taxes on inheritance. So let's dive in to our first question today from the mailbag. Listen in. A lot of these questions you might be able to relate to. You can take strategies, utilize them in your own personal situation. And so I hope you find them helpful. First question today from Tony. Tony says, I'm hesitant to pay off my house because I don't have many other tax deductions at this point. But I have $100,000 in the bank and I only owe $45,000 on the house. So it's really tempting just to pay off the house. What are your thoughts? So Tony's got a few things going on in this question here. One, he says he wants to maybe pay off his house because he doesn't have many other tax deductions at this point, thinking, is Tony still getting a tax deduction on his house or not? That's one thing. The tax deduction on his mortgage, not on his house, on his mortgage or mortgage interest or not. So that's one thing that's in there. He owes $45,000, has $100,000 in the bank. So let's kind of go through this. Now, I'm going to assume if he's got $45,000 left on his mortgage, let's just make an assumption that was not his original mortgage amount. Let's just make an assumption that maybe his original amount was $150,000 or $200,000 or $300,000. So he's on the last $45,000 here. And Tony, you can correct me if I'm wrong, but then you can also just look up as things that I'm going to talk about here to help you out. So first off, assuming that your original mortgage was somewhere over $100,000, somewhere over $150,000, it just wasn't $45,000. Tony, at this point in time, most likely all you're paying is the principal, meaning all you're doing is paying, and not all, right? You're still going to have some interest on there, but the majority of what you're paying when you're paying your principal and interest, your mortgage payment right now would be principal. And so basically you're just paying towards equity ownership in your house. The way that mortgages are structured is you pay a majority of the interest up front. So let's just say your payment was $2,000 a month. Well, when you started that mortgage, let's just say it was 25 years ago, or say it was 10 years ago. Of that $2,000, it might have been $1,000 interest, $1,000 principal. Now, though, because you've got a few years left, $45,000 left to pay on it, maybe of that $2,000, it's $1,500 principal, $500 interest. Maybe it's $1,800 principal, $200 interest. Just take a look at your most recent statement and see how much is actually now going to interest and how much is going to principal. And I'm sure my figures were way off there, but hopefully you just get the concept is now majority of your money is just going towards the equity of your home. So as far as the actual interest that you're paying to the bank, most of that they're wanting to get their money as soon as possible. So most of that you paid up front in the beginning years of your mortgage. So that's one factor to consider, is how much interest are you actually paying now? And then that can kind of lead to your tax thought as well, which we'll get to in a little bit. Next thing that you want to consider, and this is for people who look at a mortgage from just a pure mathematical standpoint, is what is your interest rate? And then what kind of interest rate are you getting on that savings in the bank? And I'll just give you my story here, Tony. For instance, I'm with you, Tony. I'm a big believer in just paying off debt as soon as possible. There's some tax deductions, but there's just this emotional freedom of having debt paid off. So, but, I use but, or maybe I should say, however, one thing that's kind of changed for me over the last year here is last year, let's see, so what was that, 2021, I was able to refinance my mortgage. I dropped the term on the mortgage to a lower term, and I was able to drop the rate to 2.5%. So for me personally, my rate right now is 2.5%. And the rate of interest that I'm getting on my money in my online savings account is, I think right now it just checked up. So at the time of this recording, it just went up to like 4%. So there's the mathematical standpoint of what you're asking as well, Tony. I'm actually making more interest on my money in the bank than what I'm paying on interest for my mortgage. So I'm coming out ahead. I typically, don't kind of look at things that way in the past, but since mortgage rates got so low, and if you refinanced or happened to take advantage of when interest rates were so low, then, that's one thing to think about and consider. And that's, of course, just taking it from a mathematical standpoint. Now, if your interest rate is 5% and you're only making 4% on your money in your bank, well, there you go. You're actually making, less on the bank than what you're paying to your mortgage company. And that right there can make it make sense to pay off your mortgage. And so, like I said, that's from a total mathematical standpoint. Then there's the emotional standpoint. And I mentioned this earlier, I'm a big believer in not having debt, and especially depreciating debt. But a home is an appreciating thing, an appreciating asset. But there is the emotional side of just having the emotional freedom from any sort of debts. And so, Tony, if you're, for instance, heading into retirement, you don't want that extra payment, just pay it off. I mean, we could sit here and think about the numbers all day long, but you know what? Working with a lot of retirees and seeing just kind of different situations between different people and, what kind of stresses them out. Most people say, and it doesn't even, they're not even looking at interest rates, they're not looking at anything. Most people just say, gosh, I can't wait to pay off my mortgage. I can't wait to have my mortgage paid off. That'll be helpful when I no longer have to pay that bill. And so from an emotional standpoint, if you just want to be done with it, pay it off. There you go. Then you're done with it. Don't have to worry about it. I mean, the back and forth from an interest standpoint that I just gave you, probably not going to add up to a whole lot of interest in regards to your lifetime. And so there you go. Just pay it off if it does come down to it that way. I always think that, personal finance sometimes is about 75% personal and only 25% finance. And then the last thing, and this probably what you were really wondering, Tony, or part of your question here, was the tax deduction. And so my question to you, because as I meet with people and they're like, okay, yeah, I've got my home mortgage because I'm getting this tax, the mortgage interest is a write-off. When you sometimes actually dig down into people's taxes, they're not actually able to write off their mortgage interest. The reason being for that is because with the Tax Cuts and Jobs Act that passed in 2017, they increased what the standard deduction is. And when they increased that standard deduction, the standard deduction became so high that it kind of brought up a time where a lot of people no longer are able to deduct their mortgage interest, deduct what they're donating to charities. And so I think, from that standpoint, you really need to look at your taxes and look at if you are actually able and have been writing off your mortgage interest, or if you're just taking the standard deduction. And if you're just taking the standard deduction, there you go. Take the $100,000 in the bank. You're no longer getting the tax deduction. If that was the only reason that you're holding on to it for, go ahead and, pay it off. So hopefully that gave you I'll kind of summarize here the different points. First off, you're primarily, most likely, if you started this mortgage a while back, at this point, your mortgage payment is majority of it's just going to principal versus interest. So that's one thing to consider. What's your interest rate versus what's the interest rate you're getting at the bank? From an emotional standpoint, if it just makes you feel better to pay it off, go ahead, pay it off. And then looking at your taxes, are you actually getting the tax deduction for the mortgage interest? Tony, I hope that helped you, but I hope breaking it down into those individual points helped other people, because Tony, I know that you're not the only one out there asking, should I or should I not pay off my mortgage? All right, next question in the mailbag comes from Brian. This is an interesting one. Brian says, I retired 3 years ago thinking that my wife would be retiring soon after me. I bought a camper and everything. I'm ready to see the country. She keeps saying that we need her to work for 6 more months, but then when that 6 months is up, guess what? She says she needs for her to work 6 more months again. How do I convince her that it's okay to retire? Oh boy. So, Brian, working with a lot of, couples that are going into retirement, I'm not sure the word convincing is maybe the right method or the right answer here. And I guess I would say I'd start with understanding why. So just to recap, you retired 3 years ago. Then your wife said you thought your wife was going to retire soon after. You got all the stuff ready to go for retirement, camping, camper, ready to go. And then she said 6 more months. And then she said another 6 more months. And she keeps saying 6 more months, 6 more months. There are a few different things that could potentially be going on here, Brian. And like I said, it's starting with why versus starting with, hey, you said you were going to retire. And here's my thought process behind that. One, and like I said, a few different things going on here. So let's start with part A, we'll call it. Part A is your wife actually wanting to retire? Does she like working instead? Or all of her friends at work? Let me share a quick story with you. I had a couple that met with the first spouse, ready to retire, ready to just, leave their job, and they knew exactly what they were going to do. They're going to fish, they were going to golf. They had hobbies, they're going to volunteer. They knew mentally what they were going to do with their day each and every day. They were ready. Fully ready. Then when we started talking, the spouse, I could see some hesitancy. And as we dug into it further, the spouse actually really enjoyed working. But it was also because they didn't have many hobbies, they didn't have many activities, so they didn't necessarily know what they were going to do once they did retire. And so work right now for them filled that gap of the day because it was something that they enjoy going to do. And at the same time, that's where a lot of that person's friends were on top of it. So they enjoyed working. They enjoyed going to work because that's where their friends were. And so looking at retirement for that person actually seemed very stressful, not from a financial standpoint, but more actually from a social standpoint, from an activity standpoint, from a what am I going to do in retirement standpoint. So maybe start there, asking or just kind of asking questions around, hey, what would you like to do in retirement? Do you want to retire? Do you not want to retire? Is it because of financials, or is it because you enjoy working and you just want to stay there and hang out with your friends? So that's part A. Let's now call this part B. Is your spouse, is your wife here, is she the saver in the family? And the reason I bring that up is because retiring and spending money is a true fear. I see this each and every day and help clients through it each and every day. Spending money, being a saver and spending money in retirement is a true fear. And this takes time to overcome. It takes a plan. It takes understanding, how much you're going to be able to spend and where those adjustments are. A lot of times what helps our clients in regards to this is what we call as our retirement income guardrails. Understanding how much they can spend and make their money last. And then at the same time is understanding where they would need to make adjustments. If the market were to go up, then they could spend more. If the market were to go down, again, not shutting off the faucet, but just where they might need to tighten the belt a little bit. I've found having those guardrails in place, and if clients can see that their retirement lifestyle fits within those guardrails, even the downside guardrail, it helps bring a lot of confidence to retiring and to moving on to actually spending what they've worked so hard to save. So just know that as well. Maybe you're the spender in the family. Maybe your wife's the saver. And for a saver, it can be tough to retire and become that spender. But having that income plan in place, knowing your guardrails, that can help. The other thing that can really help is having a full understanding of what your outflow is, meaning what your lifestyle expenses are. Truly knowing that number, because then you're able to compare that number to your income guardrails number. That will help build confidence in retiring. The other thing is factoring in Medicare, factoring in healthcare. Just having this true, fully built-in plan of all of the different factors. If spending is a fear, putting in contingencies for things that might come up, putting in money for travel, that could really help as well. Those things I find help build confidence, because then you can see the numbers aspect of it and see that the numbers aspect of it say that it will work if you're willing to make the adjustments as time goes on. And then we'll call this part C. So part C, Brian, in regards to your question here is, would it help your wife to go part-time? So I know that you want to just hop in the camper and start going and probably take, the full year off and go on trips throughout the U.S. or wherever you're headed. But maybe it would help your wife if she would just go part-time, right? So then that way, either aspect, right? If it's because she likes to work and that's where her friends are, or if it's because of a financial aspect, now you're kind of finding a balance between the two of you, meaning she still gets to work sometime. She sees that there's still income coming in sometime. But then the other part-time, right, is heading out in the camper and doing things that you were hoping to do for retirement. Quick story for you there. We've got a client where, same thing, we've put together the retirement income plan for them, which is allowed them to work, let's just call it 6 or 7 months. Was allowed them to travel 6 or 7 months out of the year and then work the other 5 or 6 months of the year. And so putting that plan together has really helped this couple do things that they wanted to do, but then come back home, put in the work, put in the time, see their work friends, see that they still have some income coming in. And then what they'll do is slowly take themselves off of that plan and go into full retirement. So hopefully, those 3 different parts there, Brian, have helped you. Helped you, and maybe your spouse is listening, helping your wife understand. Maybe you can just allow her to listen to this and she can connect to one of the parts that I've talked about and let you know, hey, this is the part. I have work friends. This is the part. It's the financial part. Whatever it might be, she can let you know what part is on her mind. And then once you know which part, understanding the why, then you can help solve for the why. So, hey, Brian, hope this helped you. Hope this helped others, because I know you're not alone when it comes to one spouse sometimes being afraid to retire, but it's always figuring out why they might be afraid. All right, and our last question from Noah. Noah said, we never spent very much money during our working years. And now that we've been retired for a couple years, we're still not spending much. So it seems that we're going to end up leaving a lot of money to our 4 kids. But I'm worried that with some of the tax changes that they're talking about, that could end up making Uncle Sam our biggest beneficiary. What kind of planning do I need to be doing in regards to this? Okay, so basically what Noah's saying is that they've saved up, they're not spending it in their retirement, they're retired, they're not spending the money like they thought they would. So they're going to leave the money, then they're going to have money that they're going to leave to their 4 kids, and they want that money to go to their kids versus going to the IRS in taxes. So Noah, for your question here, and I know that I've got a few clients just like you, Noah, who want to make sure that they're passing on some funds to their children in the most tax efficient way. Hopefully I can walk you through some different parts to think about in regards to your question. The first part I'll say is, hey, Noah, why aren't you spending? Why aren't you enjoying your money? And that's okay. But go back to the previous question and understand the why. If it's because you're scared to spend it, first off, I would say, hey, let's make sure that you have an income plan in place that helps give you confidence to enjoy the money that you've worked so hard to save. Now, after I've said that, if you look at me and said, Scott, that's great, appreciate those numbers, still don't need it, now let's talk in regards to how to pass it on in the most tax efficient way possible. So first question I'm going to ask is, where does the money sit today? And there's 3 buckets, Noah, that your money could sit in. First off, it might sit in the IRA, 401k, or what they call as the tax-deferred bucket. Now, here's the concern in regards to this type of money. When this money passes over to your children, they can inherit IRA, 401k money. They inherit it when they do. It's called a beneficiary IRA. But the rules just changed I think it was a couple years ago. The rules just changed, Noah. And so the rules now in regards to this money is when they inherit it, they don't pay any tax when they inherit it, but it's as they take it out, they would pay the tax. So all of this money, you would put all of this money away, as they call it, tax deferred. You haven't paid any taxes on it. So the IRS wants their money back. Whether you're taking it out or whether your children are taking it out, the IRS, they want their share as well. So here's the thing, Noah. This goes over to your children. They inherit it. They don't pay tax on the inheritance until now they have to go take it out. And the rule just changed. And the rule that changed was they used to be able to take the money out over their lifetime, meaning they could just take a little bit each and every year, and depending on which tax bracket they were in, maybe they could just kind of maximize that tax bracket. If they're in the 12%, they take a little bit out to maximize the 12% or the 22 or whatever tax bracket they're in. But the rule changed, and here's the new rule. The new rule is that they have to take it out over 10 years. So whether they want to take a little bit each and every year, it doesn't matter. By the end of 10 years, all of that money has to come out. So they have to really think more strategically about this. And let's just say you've got $4 million and they're each getting $1 million. That means they're going to have to take out, potentially $100,000 a year, or they wait till 1 year, they take $1 million out. That could throw them up in a huge tax bracket, maybe in a higher tax bracket than what you're in today. So one of the things to consider, because you said, hey, you want to leave more to them versus giving it to the IRS, is what I'll call is family tax bracket management. Understanding what tax bracket you're in, understanding what tax bracket your children are in, and what might make more sense is for you to start doing what we call Roth conversions. Now, you always hear me say this when it comes to Roth conversions. Talk with a tax professional as well as a financial professional to see what's right for you and your family. But you might start doing Roth conversions, meaning you pay the tax today, you get the money in the tax-free bucket. That way, when your kids inherit it, again, they don't pay any tax on the inheritance, but then the money grows tax-free, and the money that they take out is also tax-free. Now, that leads us to the next bucket here. So Roth conversion, right? If your money's sitting in the IRA bucket, that is something to consider. You consider the Roth conversion. Again, you're paying tax today, getting it into the tax-free bucket. Okay, now let's say your money is sitting in the Roth bucket. The Roth bucket, well, you've already paid tax on that money. It's growing tax-free. Your kids inherit that. When they inherit that, they're not paying any tax as it transfers into their name. It's going to transfer into an inherited Roth IRA. And now for them, it's going to grow tax-free as well. They still have the new 10-year rule on that money, right? So they have to take all of that Roth money out over 10 years. However, when they take that money out, it does come to them tax-free as well. And I guess I should say, when I keep saying like your kids will inherit this money tax-free, that's not necessarily always the case. It all depends, Noah, on how much money you have. So, for example, right now, Noah, you and your spouse, you each get a $12.92 million exemption, meaning you can, or your children can inherit up to $12.92 million without being subject to the federal estate tax. And that's, you have that exemption, your spouse has an exemption. So if you look at that as total, basically, it's over a $24 million exemption. So that's why I say, your kids most likely might be inheriting this money. As they inherit it, free of any sort of estate taxes, as long as you fall under these exemptions that we're talking about. Now, if you go over the exemptions, there's some advanced planning that you would want to do potentially with life insurance, with gifting, and some other things that I'll talk about here more in a second. Now, that's the federal level. Now, you also have to take a look at your state, because some states have a different amount, a different level when it comes to the exemptions of how much your children can inherit before any sort of state estate taxes would kick in. So make sure you take a look at how much you've saved, take a look at, and it's not only how much you saved, but you've got to put in the value of your home, of any sort of real estate that you have. So, make sure that you're adding it all up when it comes to the exemptions. So first off, make sure you understand the exemptions. That's what I'm talking about when I say, hey, they inherit it, that it goes over to them without anybody taking taxes out of it. But once they get it, then it's what happens then. The last bucket that your money could sit in would be considered a brokerage account. This could be an individual account, a joint account, could be a trust account. Now, there is actually benefits to just leaving your money in the brokerage account. It's what's called a step up in cost basis. We're just going to keep this really simple today, Noah. So for you and for everybody else that has a joint account, I just want everybody to understand the benefits of this right now when it comes to transferring money to your children. So have money in a joint account. Let's just say the stock that you bought, when you bought it, the value of that stock was $300,000. Let's say that joint account, now the value has gone up to $600,000. I know what you're thinking. If you were to sell that stock, Noah, you've got $300,000 in gains that you would have to pay taxes on. However, when you pass, your children inherit that joint account and they get what's called a step up in cost basis. So when they inherit it, they don't inherit it at your original cost basis, the $300,000. It steps up to the value of that account, what the value of that account was when you passed away. So it steps up to the $600,000. They inherited at that value, not only the value of what it's actually worth, but they inherited at that value from a cost basis standpoint. So now we take the value, $600,000 minus the cost basis, $600,000. Your children don't have any sort of gains or tax on that money. Now, if they let the money sit there for a while in that bucket, and then let's say a year goes by before they distribute it, and that $600,000 now has become $700,000, well, they will have gains, will have tax that they'll need to pay on the $100,000 difference, right? So hopefully I'm just going to recap here. You started at $300,000. That was your cost basis, your original amount in. It grew to $600,000. You would owe gains on that $300,000 difference. You pass away. Your children now inherit it at $600,000, the value, but that's also their new cost basis. They let it sit there for a year, grows to $700,000. They will pay tax on that $100,000 of gains. That's why on those joint accounts, trust accounts, individual accounts, it sometimes makes sense to go ahead and liquidate it right away. So that way the children don't have to worry about any sort of gains, and then it can go into an investment in investments that makes most sense for them and for their plan. Okay, and then just to wrap up, so as we've kind of gone through here, Noah, it depends on what kind of bucket your money is in. Some buckets you're going to have to worry about Uncle Sam and start implementing strategies to reduce the tax that Uncle Sam would get. Some buckets you don't have to worry about it. Now, let's just say you are over the exemption limits, or let's just say you realize that you could potentially just help your children. Now, one of the things that you can do is you can gift to your children each and every year. Now, they change the exclusion limits each and every year, and somebody could be listening to this in this year, 2023, 2024. What you want to do is look up the most recent annual gifting exclusion amount. And then what you can do is you can gift to each child up to that annual gifting exclusion amount without having to worry about any sort of tax. Now, if you pull the money from your IRA, you will have to pay tax on it. If this is money sitting in your checking, savings, brokerage account, joint account, you name it, then you can just gift that over to your children, stay under the amount, nothing that you have to fill out or turn into the IRS. So there we go. Hey, I hope that you found all of these questions of value and benefit. If so, subscribe on your favorite podcast player. Please keep sending in the great questions. Really love getting them and then talking about them. Again, the last week of each and every month, we're going to open up the mailbag, talk about the most recent questions that came in. So to Noah, Tony, and Brian, thank you for sending in your questions. If anybody has any questions, go to lifemoneyshow.com. Again, that's lifemoneyshow.com. Click on the most recent episode, and you'll see on the right-hand side where you can submit your question that comes to us. We'll talk about it on the show. Hey, subscribe on your favorite podcast player. And also, like I mentioned earlier, if you haven't yet, check out our YouTube channel. We've got a lot of videos there to help you build wealth and help you minimize the taxes that you'll pay to the IRS throughout your retirement. Our latest videos, we had the 10-point checklist to understanding if you're ready to retire, 3 mistakes to avoid planning for retirement as a couple, and 3 factors to consider before you file for your Social Security. You can find it at Sierens Financial Group. That's SIERENS. And I look forward to our next conversation to helping you enjoy life today and being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.